So we've learned about IRMAA, and we've learned about what triggers IRMAA. We're going to talk about this RMD effect, because that's the next thing we have to consider. Well, if we're not tax efficient and we don't do these things called Roth conversions, how can we manage this? So the way we look at it is, and this is how to potentially, I think we covered this. Who does it affect? It affects everybody who with a modified adjusted gross income over a certain amount. What is the cost? We looked at the cost. Why is this often missed? Okay, let me talk about that before we talk about planning. Planning to how you can plan to eliminate or reduce it. So why is it often missed is because, first of all, with individual investors, it's not on most people's radar until they get that bill in the mail, or less, less comes out of your Social Security if you're collecting Social Security. Financial planners don't like to talk about it. And either they don't like to talk about it or they don't know. And both of those are bad situations, because it's really hard to show somebody a failed plan. It's really, really hard. And you should, as a planner, you should have methods to fix it that are sometimes uncomfortable for people. And they either follow your direction or they don't. But it's much easier to show somebody a positive plan. And we see this all the time. People come to me and they say, I've been working with my financial planner for the last 25 years, or my financial advisor for the last 25 years. And every time we look at it, he says, well, geez, you're going to have, $10 million by the time you're no longer here, and everything's going to be rosy, and you can spend whatever you want and go get that, RV or yacht or second home or what have you. But when we really dig it, and when I look at it, sometimes we see, well, you've got potential issues here. Sometimes it's you're running out of money, or you have significantly less than what you might be considering, because things like IRMAA aren't automatically calculated in some financial planning platforms. Things like out-of-pocket costs of Medicare or medical expenses after Medicare aren't automatically calculated. Higher taxes aren't automatically calculated, and actually difficult to assess in a plan. It takes a lot of work. So financial planners don't like to show. They don't like to show failed plans. They like this. They like to be positive and show you how everything's going to work out. Everything you should. We've had people we've had to ask to leave the firm because we're looking at a failed plan that we could make successful, and they weren't willing to take the steps. So that's different. Sometimes you start with a failed plan, and you can often you start with a failing plan and you make it work. But what I'm trying to say to you is that people want to show you a positive result, and sometimes they show you that by omitting certain things, either usually not intentionally, but they just may not know about it. Sometimes intentionally, or sometimes they're just very optimistic. So why is it often missed? Individuals don't know about it. They're completely missing it in their plan, and it's just not a standard discussion in the financial planning world. True financial planners will include it, but a financial advisor who also does a financial plan, that's usually very, very surface and does not show these kind of things. So, and here's what you're here for: how to potentially minimize or eliminate IRMAA. Well, what we like to do is tax efficient planning. So moving things into Roth IRAs, sometimes cash value life insurance, and we look at the effect of that. So let me explain to you what we're looking at. Let me close this here. How are we doing with time? We're okay. So here's a comparison of one page of a spreadsheet that we use. These are internal spreadsheets that we use to see what the effect is on different strategies. So here is, client comes to us and says, okay, this is my situation now. This is what we call base facts when a client first comes to us. This is my situation now. You know what? I'm going to take me away because I'm trying to fill up the whole screen. This is my situation now. I've never heard, I haven't considered higher taxes. I haven't considered all these other issues and items that you've brought to my attention. And, my plan looks successful, but we want to make it more efficient. So this is what may happen. So in this case, this person turns 75 here. This is RMD. And this is what Ed talks about in that slide, that chart I just showed you where it said the effect of RMD. So in this case, they have no IRMAA. So no IRMAA in these years. This would have been the year that they turned 65. No IRMAA in these years. And then suddenly they start hitting their surcharges. And they start hitting the surcharges every year because of RMDs. Now, folks, do you have an option not to take your RMD? Well, other than qualified charitable distributions, no, because you're penalized if you don't take it. So that's money that must come out of your traditional IRA. Now, let me address these static charges. $10,382. Again, I'm sharing with you an internal worksheet that we have. And we made a decision not to inflate these charges because we'd have to inflate it. We'd have to just make an assumption, a guess, about the inflation numbers on IRMAA. And we'd have to make some assumptions about the inflation numbers on the tax brackets. And they're not necessarily aligned. So we start with the premise of what if nothing changes? Because if these numbers were inflated, the differences would be larger. So we say, okay, if nothing changes and everything stays the same the way it is today, as far as the IRMAA brackets and the tax brackets, because remember, it's based on modified adjusted gross income. What effect will it have? Can these steps that we're taking, Roth conversions, using cash value life insurance, if that makes sense to you, does it have a positive effect on their lifetime IRMAA, income related monthly adjustment amount, or a negative effect? And in this, we have two different plans here. So this is base facts. So the base facts is if you never attended this webinar, attended a class, met us, and you just went along with the tax deferred paradigm of putting all your money, keeping all your money in tax deferred IRAs and 401ks, what would happen absent inflating these numbers? Well, if you lived to be 95 years old, you'd pay $240,000 in extra IRMAA costs. So, and this is not inflated. So think about that in your head. Just add 3% on there. And I'll give you the exact math on that. It's a lot more than that, right? So $240,000 that most people aren't considering until it happens to them. And that's where plans can start to fail. Now, this is base facts. So this assumes you never met us. We're not doing any tax efficient planning. We're not doing any efficient and effective planning. Now, here's plan number one. We said, okay, what if we did Roth conversions, these things? Now, I want to share with you, we've reduced their IRMAA by $74,000 over their lifetime because they pay it for this period of time and they don't pay it for this period of time. So just like taxes, we're kind of front loading. So that's step number one. Well, that's not good enough for us. We're good, right? That's good. That could be a home run, $75,000. Just round it up, $75,000 plus, right? Because of inflation. Yeah, you're seeing that. But now here's plan number two. All right, what if we did other things? Now we're paying more IRMAA early in life. We're triggering it right away for these folks. Plan on it. Here's it. Bill's coming. Let's make sure you're planning on it. And they say, holy cow, you're telling us to pay more in tax right now. Now you're telling us to pay more back to the federal government because we have our Medicare expenses and now we have this thing called IRMAA. So Mark, what is the effect to us? Well, that's a savings. Well, that brings it all the way down to $89,000. And that's a savings of $151,000 plus for inflation. So a savings of $151,000 over your lifetime, folks, I think that's impactful. So with inflation, I'm sure this would be plus the $200,000. But this is an example of how you can plan for it. So how did we do it? It's right here, Roth conversions. These are principal protection. These are well, the principal protection helps on not just the investment management, but financial planning side of it too, with guaranteed lifetime income. So at this point in this example, so this is a real life plan that we happen to be working through with somebody right now. That lifetime income will come out tax free. because it'll be converted to Roth by the time it's drawn out. And they also have life insurance as part of your plan. So all those things combined, using the tax bracket, it's kind of like paying your taxes earlier. You're getting this out. It's very much like that. You're getting this out of the way now. And what is the effect? And the reason we want to see this for ourselves and the reason we want to show it to the client is because, goodness gracious, you've got to be reminded and see what the difference is between these plans. So let me go back to our notes here. So I think we've hit everything here. So in this part, we've talked about the Medicare surcharge, income-related monthly adjustment amount, and what you may be missing or maybe your other financial planner or financial advisor isn't considering. We talked about what IRMAA is. We talked about how it's calculated. We talked about who does it affect. Don't forget about your spouse. As soon as one of you passes, the IRMAA brackets are completely different. Remember, go over here to this slot report, or this slot chart. Everybody has access to this. Just go to attleborowealth.com. The slot corner. If you don't know what I'm talking about, go back to a little bit in the beginning of this video. We're going to talk, not the beginning, but maybe about that 10:40 mark. Well, you don't know what time it is when you're watching this, but and download this chart. It'll tell you everything you need to know about how, there's information about qualified charitable distributions. I didn't get to that. Other tax-free sources. If your funds are coming out tax-free from your, you got your buckets: taxable, tax deferred, tax advantage, or tax-free. Taxable, tax deferred, tax advantaged, or tax-free. Anything that comes out of here is going to add to that IRMAA category. Anything that comes out of here is going to add to that IRMAA category and calculation. Anything that comes out of here, no IRMAA, folks. Doesn't, as long as it's qualified and as long as it's coming out of a Roth or a properly structured cash value life insurance, or what we refer to as life insurance retirement plan. The only exception to something that comes out of here that doesn't apply to IRMAA is a qualified charitable distribution, right? Because it never hits your tax return. So that in a nutshell is how you position yourself so that you avoid these things like IRMAA over your lifetime. And this can be the effect, right? This sheet that I showed you here. And this, folks, is all the general information you want to know about it. You need to know about it. Implementation is a whole other area. So I think we've covered IRMAA with just about everything we can for today. If you have questions about it, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. It takes awareness and it takes planning to avoid these things. And you saw in this example that I showed you, it's $151,000 difference over this client's lifetime plus for inflation. And if you think that's meaningful for you, then you should pay attention to it and get to work on it. If you don't think it's meaningful, then you can just move on and let the government take your money in another way, like IRMAA. If you want to reach us, you can reach us to either ask questions or schedule an appointment at questions@attleborowealth.com. If you want to see where to download that chart, you go to attleborowealth.com. That's attleborowealth.com, and you go to that slot corner and download this chart and any other chart you want. That is it for today. Leighton, hey Leighton. Leighton said moving to Medicare. I guess maybe I misspoke about something, but I apologize if I did. If you haven't already, subscribe to our YouTube channel, and if you like the video, hit a like. If you and hit that notification button. So subscribe, like, and notification. And if you want to, if you got a benefit out of this, share it with your friends. Okay, that's it for today. Have a great week. Have a great Tuesday, and we'll see you next week. Take care.